Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The pace of deal making in recent months has been quite extraordinary. It seems every week, almost every day in fact, we're talking about another merger or takeover bid. Then consider the number of IPOs so far this year. More than 120 companies have debuted on the ASX already in 2021, and we're only in October. Globally, IPO activity this year has already exceeded last year's total. Duncan Hogg is the EY Oceania Head of M&A and my guest this morning. Duncan, welcome back to Fear and Greed.
Oh, thank you, Sean. Thanks for having me.
What's going on? Why are there so many IPOs out there? Why is there so much M&A?
Yeah, look, it's really one of complete sort of market confidence. I mean, we obviously had sort of 18 months of COVID and people's concerns around what COVID might mean. And now people are really looking at COVID in the back mirror and are thinking about, well, what's next? And in doing so, what COVID has also done is it's allowed really cheap cost of capital to come into the market. And that has enabled people to essentially put the money out into the market and through M&A, because ultimately, if you leave in the bank, you're going to get no return.
I get that. But the thing I sometimes wondered about IPOs particularly is that they are going to the market mostly to raise money to fund growth, very, very broadly speaking.
Yes. Yep.
There's also really cheap finance to do it other ways, bank debt, for example.
Yeah, no, there is. There are cheaper ways to do it through bank debt, but in the end, ultimately, you have to have a level of equity sitting within a company, and the IPOs are really sort of seen as not just a growth opportunity, but also an opportunity for founders or private equity players to really release some capital through the equity markets. So in that way, they can see an opportunity there where there's high valuations, and they want to pursue it.
Okay, so where are we seeing most of the activity? Let's talk about IPOs first, and then we might go on to M&A.
Yeah, so most of the activities actually, and I think most of your listeners would expect this, is actually in the technology space. So around 35% of all IPOs globally have been in technology. And that's really driven by an expectation that they're high growth type companies and people want to get in there early to obviously participate in their growth. The other one, which is another one, which I think your listeners would expect, would be healthcare. Just given what's happened with COVID and the dislocation of really the healthcare sector driven by COVID, that's sort of seen a number of healthcare stocks come into the market as well. Once again, with investors sort of supporting them, just given the growth profile of healthcare over the last sort of few months.
Okay, and then in the M&A space, it seems just very anecdotally, infrastructure, obviously, because of super.
Yes.
But even energy, there seems to be lots going on in energy as well.
Yeah, the two largest sectors are definitely infrastructure and energy and utilities in Australia. The infrastructure side, we have quite a sophisticated infrastructure market in Australia, not only from a listed perspective, but also just from an investor perspective. So we are seeing a number of the sort of global super funds, both here in Australia and overseas, looking at what we have listed on our market and seeing a real opportunity there. And then with energy and utilities, it's really driven predominantly by what's happening with, firstly, ESG issues. So that's environmental, social and governance issues. So there is sort of a bit of a movement in that space where consolidation is seen as the best way for a number of the energy companies to think about ways in which to defend themselves against these sort of oncoming ESG issues.
Okay, the other area, the other sector which I always find interesting is gaming in Australia. And buy now, pay later is very different, but that's the other one. We seem to be very good at listing gaming stocks that operate in the US or buy now, pay later stocks that basically operate in the US.
Yes, no, we do. I mean, we're obviously, once you have a market that has strong comparables, like we do in the Australian Stock Exchange, then what that means is that then someone else looks at our market as a way in which to list. I mean, for example, I listed a company earlier this year where they had strong US comparables, so very strong sort of companies that were equivalent type companies in the US. And one of the things we considered was whether we actually list the company in the US for that basis. Yeah. But in the end, we actually convinced people to look at the US sort of multiples in terms of looking at that IPO.
Okay, so some of the IPOs coming up, we've got GQG Partners, which is a US fund manager, and that's supposed to be worth more than $1 billion. Judo Bank's another one. There still seems to be a bit in the pipeline for the next couple of months.
Oh, no, the pipeline's looking very exciting. I mean, so we had a reasonably quiet third quarter, and that was really driven, I think, by lockdowns in New South Wales and Victoria. But the pipeline is very strong. I mean, I think we're looking at probably one of the biggest quarters coming up. As you point out, there's a number of IPOs that are going to be $1 billion plus. We only had about $1 billion of IPO raisings last quarter. The quarter prior to that, there was about $3 billion. And we're looking to potentially around about $4 billion potentially in terms of raisings coming. So it's going to be a big quarter.
How often do you get $1 billion listing?
Not that often, Sean. That's the thing. I mean, it's a bit like how often you get a $10 billion M&A transaction. Same thing. I mean, we've had a number of those. So this is quite an extraordinary market. in the end, we don't know when it'll end. It will end at some point because they always do. So it's just a question of enjoying it while it's there, and then and just making sure everyone's aware that this will end at some point.
And have the IPO, I mean, Newey 12 months ago listed, did well till February and then hasn't done so well. I think that probably people were warned off it a bit on the back of that. But as an investor, how have these IPOs this year gone? Albeit very short-term returns here, but I'm just interested whether most of them are listing and kind of trading about where they're listing or not.
Yeah, look, it's we did some analysis on this a few months back. So this is slightly outdated, but when we looked at it, if you invested $1 in every single IPO that's occurred this year, I think the return was around about 18%.
Right.
The way you price an IPO is you generally try and give a bit of upside to the investor base because that encourages people to come in. We call it an IPO discount. So from that perspective, you would expect them to turn up. There are obviously ones that underperform as well. And so therefore, you always need to really understand the fundamentals of the company you're investing in rather than just jumping in on any IPO.
Okay. Stay with me, Duncan. We'll be back in a minute. I'm speaking to EY's head of M&A, Duncan Hogg. So how does Australia compare to the rest of the region and the rest of the world in terms of IPOs at the moment?
Look, we probably had a quieter quarter than most of the rest of the world. So, in fact, Europe had a big resurgence in IPOs, and the US continued to track pretty well. Asia Pacific also had a strong sort of quarter, but they're actually expecting the opposite to us, and they're sort of expecting a slowdown in this fourth quarter. Whereas Oceania, where we're expecting obviously a growth quarter. So, but generally, I mean, it's positive market confidence globally, just given the amount of money, market stimulus, and just confidence in the market that's out there.
So I just want to talk about the role of super funds in all this as well, because throughout the year, I've continually talked about super funds buying assets, particularly infrastructure.
Yes.
How big a role do they play in this sort of IPO and M&A business at the moment?
Yeah, I mean, I think as most Australians would know, every year they've got to put money into super. Therefore, the superannuation fund has to take that money and put it somewhere. The two main areas they put that money, or the primary area they put that money is in equity capital markets. And then they also look at what they call alternative investments, of which infrastructure is a large part of that. And so with the equity markets continuing to go up, the allocation that needs to go to infrastructure therefore increases because they need to maintain an allocation between equity, alternative investments, cash, etc. And in doing so, that's really driving the superannuation funds to look at what's out there in the infrastructure side. So as we continue to grow our superannuation base, we'll continue to see superannuation funds looking at opportunities to take companies private.
Do they put too much price pressure into the market, do you think?
Look, I mean, in the end, they are long-term. Superannuation funds are long-term investors. They might be seen to be paying a high price at this point in time, but these are really long-term assets. I mean, look at Sydney Airport, for example. That still has another 85 odd years or 80 years to run on its lease. So they're taking a long-term view. So in the short term, it might look expensive, but from their perspective, they'll be long-term holders of these assets because that's what they need to do to match the superannuation that they're having invested in and will have to pay out in the future.
Okay. If we look at some of the really big M&A deals, so Square's $39 billion acquisition of Afterpay, you mentioned Sydney Airport, the consortium led by IFM is paying towards $24 billion for that. There's a $21 billion Santos Oil Search merger, BHP's deal with Woodside over the oil and gas business. Do you think this is just a moment in time, or do you think we're going to keep seeing this for the next 2022, 2023?
Look, I mean, my view is I think this is a moment in time. I think this is, as I mentioned before, this is an extraordinary period we're going through in terms of number of large deals in the market. What it does show to me, though, Sean, is, and we always used to think this as bankers, was that the certain companies were beyond approach.
Yeah.
Whereas now you're looking at, $40 billion transactions in the Australian market, which we used to look at the US and always be in all of those size of deals. And now we're seeing them down here. So basically anyone is now a potential target.
Yeah, I mean, the Afterpay one is quite incredible because we never thought a US financial payment system would come to Australia. Do you think that could happen in the other sectors of the economy?
Potentially. I mean, Afterpay is actually I just noticed, I looked the other day, it's in the top 10 deals this year in M&A globally. So it is a big deal. So what it does show is that if you're able to create a company or a company has global reach, as Afterpay was doing, there's obviously some big players globally who might come out and have a look at the Australian players.
Be interesting to watch. Duncan, thank you for talking to Fear and Greed.
Great. Thanks, Sean.
That was Duncan Hogg, the EY Oceania Head of Mergers and Acquisitions. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.